Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 305 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, I just want to talk about the stock market, right? It's the first day of a new month, right? So I want to kind of recap what went on last month, what we should think of what went on last month in the stock market, and how we should react to what went on last month in the stock market, right? I think that anytime you see a down month, anytime you see the stock market sliding, it's good to get some perspective. It's good to get some understanding of what's going on, and it's good to know what to do, know how to act, because ultimately your actions in your financial life, as I say all the time, your actions are what's actually going to get you there. I want you to act. I don't just want you to hear and learn. I want you to act upon the knowledge that you gain. So we'll discuss all that and more about this past month in the stock market in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual watching or listening to the show on a day-to-day basis. Now, in the grand scheme of things, September of 2021 will be remembered as, a month that didn't really mean anything, right? September of 2021 will be remembered as, a month where the market just did what the market does, okay? But in lieu of everything that has gone on in the past, year and a half or more, right? September of 2021 kind of sparks some thoughts and sparks some ideas and sparks some worries in a lot of people, and for several reasons, because we have been roaring upwards since the crash of March of last year because of the coronavirus pandemic. We've been roaring upwards. Now, it's not to say that some months haven't done better than others, because they have, right? But we've seen very little in the way of pullbacks, right? Especially by historical standards, we haven't seen pullbacks almost at all. Right, the whole mantra of buy the dip has become, a dip being 0.5%, and people will buy the dip, right? But now we're looking at a dip that is deeper than 0.5%, right? We're looking at about a 5% drop in the stock market overall in the month of September. And so it's interesting to note like how we should think about this, how we should look at this as investors, and especially if you're a young investor, right? If you're a young investor and maybe you just got into the market last year for the first time or whatever, you may be struggling with like, why is the market not going up? Why are all these stocks that I like getting hammered, right? Why is this not working for me, right? And these are good questions. But even though September ultimately will be remembered for very little, right? It was the worst September performance that we've had in the stock market since 2011, when the European debt crisis rolled markets, right? So this was 10 years that we went without having a particular month, September, that was this bad. Now, again, that means very little, but nonetheless, we are down. We are down about 5% off of highs, right? But this time around, the trigger was several issues, right? There was China's Evergrande groups, right? People are calling it Evergrande, right? Their financial troubles slammed markets before the People's Bank of China assured markets that it wouldn't allow the company's defaults to spread into the broader banking system. U.S. companies saw earning estimates revised downward because of supply chain constraints. Bond yields rose, which puts a dent into valuations of technology companies. Right? These are all catalysts towards the downside, right? These are all things that lead to the market being less valuable, especially in the short term. Now, October won't necessarily get much better for stocks, right? So dating back to its inception, the S&P 500 drops 0.4% in October after the index declines 2 or more percent in September. Right? So the Dow typically falls 1% in October after such a drop. The NASDAQ, however, goes on to see an average October gain of 1.7%. So there is some good news, right? Those historical averages may be skewed by a smaller number of particularly horrid Octobers like October in 1987 when we had Black Monday, right? You can have some skewed numbers. In fact, all three indexes rose for the slight majority of Octobers, right? So if you look at most Octobers, you typically see rises, but we have seen some particularly bad Octobers. We've seen Black Monday. We've seen these types of things happen, and October is not always a great month. Now, as for this year, investors were watching a few items that could still keep stocks down in the near term, right? The Federal Reserve will likely soon be buying fewer bonds, which will put less money into the market, right? Less quantitative easing, right? In order for earnings estimates to stop falling, supply chain constraints likely have to ease, right? Which this may be a problem that is not that easy to fix, right? It's not easy to fix supply chain issues when they are so broad. And investors still need to hear from the Biden administration and Congress about how high corporate taxes might go. History is a nice guide, but it doesn't outweigh fundamental developments, right? So if we look over the last 10 years, I said this was the worst that September has been in 10 years. Let's look back, actually a little more than 10 years. Let's start in September of 2010. Right, in September of 2010, the market was up 8.76%, the S&P 500, right? So no slouch, good month, very good month, right? 2011, it was down 7.18%, right? So that's why this month was the worst since that month, right? Then 2012, it was up 2.42%. 2013, up 2.97%. 2014, down 1.55%. 15, down 2.64%. 16, down 0.12%, so basically flat. 17, up 1.93%. 18, up 0.43%. 19 up 1.72%, 2020 down 3.92%. Now 2021, we're looking dead in the face of a 5% plus drop, right? Yesterday alone, you look at the S&P 500, down 1.19%. The Dow down 1.59. You have companies like Berkshire Hathaway down 1.57%, right? You've got small cap indexes down 1.32%. Right, you've got the QQQ down only 0.37, but still down for the day. So basically everything was down. A lot of things were down on Thursday. So we're in the middle of a decline, and there's nothing wrong with that. It's perfectly natural and it's perfectly okay. Right? But we're just not used to it anymore. Right, the old saying is typically at least once a year you would see a correction of 10% plus. And even though that's held for most years, some of those corrections that we're looking at are these big market crashes, right? But we're not seeing as many, at least in recent years, of these 10% plus corrections that are normal over the long term in the stock market. Not only have we not seen 10% plus drops, right? The S&P 500 went 227 days without a 5% drop, right? I believe this was the longest that it's ever gone without a 5% drop, right? Which is crazy. And again, this all goes back to people buying the dip at all times. They're buying the dip when buying the dip is not even really necessary, or when buying the dip is, buying a 0.5% down or a small percentage down, right? Not when you're buying 10%, 15%, 20% declines in the stock market. Now, obviously, those things are less common. It's less common to see 10+% declines. So you have to make a decision. When do you want to buy? When do you actually want to get in to the market? When do you actually want to put more money to work? Or do you want to put more money to work at all? Right? Yes, this was a bad month, but this bad month has me thinking about a lot of things as an investor, and I want to share with you what some of these things are, because I think that the way that I'm thinking about this market, the way that I'm thinking about the way that September was and the way that we're going to move forward might actually help you, right? So I want to tell you some things that you can do after the worst September in a decade that can be profitable to you, that can make you a lot of money, right? And I think the first is probably the most important, right? The most important is, no matter where stocks go from here, no matter where the market goes from here, do not divest. Stay invested, right? Do not divest unless obviously you need money for something, or there's a specific reason that you're taking money out of your accounts. Do not divest. Don't divest because of what the stock market does, because it is not going to be beneficial for you to do so, right? You are likely to lock in losses and not get in time to get the gains that you could have gotten otherwise, right? The stock market is not very friendly to those who try to time it, so I would not even try, right? May that mean some short-term pain? Absolutely, it may mean some short-term pain, but over a longer period of time, as we see the way that our money grows, the way that the market moves, we're going to be perfectly fine. Not only are we going to be perfectly fine, it's, history has shown that we will be up even more later on. Okay. So I would absolutely not be taking money out of the market just because we have had a bad month, right? The thing that you have to remember is the time to take money out of the market is not once it started going down. The time to take money out of the market, obviously the perfect time is as it peaks, but who knows when it peaks, right? So a lot of people like to take money off as it's going up, but then they can miss out on gains as it's going up. Some people do like to try to take money out of the market when the market starts to go down, but when the market starts to go down, you've already taken some losses from the high, right? So the perfect time to get out doesn't really exist, right? Ultimately, you're likely to miss out on gains. You may make yourself to where, hey, I don't have to take as many losses, right? But people's ability to time when to get back in is pretty horrid, right? People don't have a good gauge as to when to get back in. And most ordinary retail investors don't get out when the market's just down 5%, right? They're getting out when the market's down 15, 20 plus percent. Right? And then they wonder why they don't make money because then they're waiting for the market to get back up to a high to get reinvested. That's just not the way to go. So if I tell you anything that you're going to listen to in this episode, stay invested. Now, on top of staying invested, I do believe we should buy the dip, right? Now, this does not necessarily mean that you need to take new money and go out and buy the dip, right? I think that sometimes buying the dip can be easiest done by just our systematic investing, right? I was talking to my wife earlier and telling her like, hey, it's kind of nice. I like when markets are down at the end of a month because what happens at the first of every month? The first of every month, we have automatic investing, automatic saving that's going on in our investment accounts, right? And so that money gets invested when the market's down. And I love that. And I think that's something that can benefit us, especially as the market's going down into the end of the month, is that you can buy the dip and you can buy it without having to do anything extra. You can just keep your regular investing going on and it will allow you to buy the dip. Now, the beauty and the curse of systematic investing is that you're going to buy dips and you're going to buy highs. Right? And we've been buying highs for some time now, every single month. But now we're buying a pretty good dip going into October, right? And so that's one way that we can buy the dip. But if you do have extra money that you want to put to work, then by all means, buy the dip, right? Buy a 5% down market because guess what? You just made yourself more returns than you would have buying the high. Now, that's not to say that the market will not go lower, right? This is not what I'm suggesting. I'm not suggesting we have hit a bottom. And I'm not suggesting that we're going to just skyrocket out of the bottom. No, that's not what I'm saying. But what I'm saying is that if the market's not at a high, and especially if the market's down 5+%, right, then you just found a place that you could get in that is cheaper than where the market is today, right? If you just do some simple, just looking at a chart of the S&P 500, and I'm going to pull it up here, right? If I want to look at a chart of the S&P 500, and I want to look how far back this would take me, right? So it is, let's see, September 30th is the last date that we have. If you want to say, okay, where are we flat from? We are flat from July 20th, it looks like, right? So from July 20th to September 30th, no gains, right? So basically what you're doing is you're taking yourself back to July 20th, right? You are getting the option to invest earlier, right? This is buying you time. That's the thing. When you buy a dip, what it literally does is it buys you time with the money that you invested, and you don't even notice. Right? You notice the returns on the back end from buying the dip, right? But what you don't notice is that it actually buys you time, right? Let's back up even further. And I know this isn't relevant to necessarily, what we're looking at right now. So if you invested at the bottom of the coronavirus crash, right? You know how far that would have taken you back in order to have made no gains, right? So that was March 20th of 2020, right? That's around the bottom. It would have taken you all the way back to February, the second week of February in 2017, right? So it took you back 3 years as far as price level. So if you were buying at that point, you gained 3 years of investing with the money that you put in, which is fantastic, right? And if we can buy ourselves time, that is not for sale, right? Then by all means, buy that time. That's the way I like to think about this. It is buying time just as much as it is buying investments. It's buying time just as much as it is buying a dip, right? Because we can't get time back, but we can get price levels back. And when we get those price levels back, we want to be taking advantage of those levels. And then if you just back up further than that, I mean, you could look at some, major examples of situations where it took us this long to get back to something. You just think about the height of the dot-com bubble, right, was in about August of 2000. Right, we got back to a positive gain around 2007, but obviously then there was the financial crisis when the market crashed, right? And it took us until 2013. So from August of 2000 to February of 2013 on the S&P 500, just the price to get back to even, right? And so if you would have been investing in 2013, you could have been investing at the same levels that were going on in 2000. Right, but if you were investing obviously at those highs in 2000, then that didn't really do you too well for 13 years, right? But as long as we are systematically investing, we're buying highs and we're buying lows. We get a smooth cost, right? We get our costs smoothed out over time, and that's what we need to do. So buy the dip, whether it's new money or the money that you're just systematically putting away, and you won't regret it because you can buy yourself some time. Now, I'll reiterate. Does not mean that this is the bottom. Okay, I don't want you to think that we're at the bottom of the market and you're just going to shoot up from here, or that the market's going to do what you think it is, right? So that kind of brings me to the next thing that I want to tell you. The next thing that I'm thinking about this market is don't get disillusioned that the market's just going to go back to the way it was. Okay, if there's anything that we know about the stock market, especially in the short term, is that trends change. Okay, now in the long term, history rhymes, right? History looks a lot like itself over a long period of time. But in the short term, trends change. And we have to think about what was hot last year and think about what's been hot in tech stocks and all these types of things. And a lot of them have already taken a beating, right? They've already come down quite a bit. I think if we look at Apple stock, I think Apple has come either down 10% or almost down 10% from its high. Let's see what we got here. So we had a high there the first week of September, and yeah, we're down about 10% on Apple since that high in early September, right? So great companies taking a beating, right? So if you are an individual investor, right, buy a dip too. Buy the dips in the stocks that you really like and that you have high conviction on because you can get them cheap, okay? Apple's not the only one, but that's one that just came to mind for me. But this brings me to the next thing that we just cannot be disillusioned that the market's going to remain the same. We cannot be disillusioned that value has no place in our portfolio, or we cannot be disillusioned that international stocks are never going to win. We can't be disillusioned in any of these things because there are a lot of confounding factors going on right now that are not in favor of the market, right? I don't know if you guys have heard about all this going on with the debt ceiling. Right, and that's they've got a few weeks in Congress to get that all ironed out. But if they don't, and we get past that, I think it's an October 18th approximate date. If we don't get that ironed out and we default on our debt, get ready to buy some dips because the dips are going to be wild because we've never done that, right? We've never defaulted on our debt, and we say that we never will, but we have to increase the debt ceiling to make sure that we don't, right? So this is all. It's all very interesting, and it's all things that are fighting the market right now. It's fighting the market to go higher, and it's okay. This is something I want to remind you, right? It's still perfectly fine because if we just look at the S&P 500 year to date, even with the market doing what it did in September, right, we're still up 16.4% year to date. That's a fantastic year in the stock market, right? On average, that is a great year in the stock market. So we cannot be shocked that the market took a break, right? And if we look back, 1 year we're up 27.4%. That's a great 1 year return, right? So let's not be, disillusioned into thinking that we've got it all bad or that the market's changed so much or whatever. We have to stay invested. Now, something that's really interesting is I'm looking at these charts, and just because it's a perfect round number. The S&P 500 as of the close yesterday in 5 years, exactly 5 years, is up exactly 100%. So if you would have invested your money September the 30th of 2016 and then held it until the close yesterday, you would have doubled your money exactly. You would have exactly doubled your money, which is pretty cool, right? That's pretty neat. That's the case. But nonetheless, right, we need to get invested. We need to stay invested and not worry so much about these short-term fluctuations, because even though a month feels like years, especially for young investors, it's not. A month is a short period of time, right? You have your whole lifetime to be investing. And so a month is not much, right? And there have been horrendous, just think back for a second to last year. Think back to March of last year. And I mean, 34% down on the S&P 500. I mean, that's a shellacking, right? We took an absolute shellacking in the market. But if you had the guts to buy, then you've made great returns on the other end. Undoubtedly, you've made absolutely great returns on the other end, because if you go back and you look, okay, what if I bought that low? From that low to the close yesterday, that's 86.88%. So you could have almost doubled your money in a year and a half, or 19 or 20 months, whatever, right? So that's just something that we need to keep in mind, that even though the market's been moving so fast, the market doesn't have to move fast. The market moved sideways for much of the 2000s, right? Like I told you earlier, it took us from 2000 to 2013 to get to some sustained new highs in the S&P 500, right? So just don't expect that the market's always going to stay the same, and don't expect that the winners today are going to be the winners tomorrow, because this is something that Warren Buffett actually talks about, is that if you look at the 25 largest companies or 20 largest companies 30 years ago, some of them you have never heard of, right? And I think it was a list of 20 that he did at their shareholder meeting, and 13 of those 20 were not U.S. companies. Now, a vast majority of them are U.S. companies, but many of them were Japanese companies. And now I think there's like one Japanese company in the top 20, right? So things change, right? Markets change, but we do not have to change. Our mindset on investing does not have to change, right? We need to maintain our long-term outlook, because the moment that we decide that we're going to start making short-term moves is the moment that we're likely to get bitten. Okay, the moment that we decide, hey, I'm going to sell everything before the market decides to go down, that's the exact moment that the market's going to roar back upward, and you're going to look quite foolish, right? Yes, it hurts to watch the market go down. I understand, right? But this is what you have to understand. Your money is not lost until you actually sell, right? You have no losses until you sell. Yes, they call them unrealized gains or losses, right? They call them unrealized losses, right? But you haven't realized any losses. You don't have any true losses. You don't get any tax break on the fact that you've made, some losses on paper. You only get a tax break once you've locked in those losses, because that money's gone, right? And we don't want to lock in losses. We want to stay the course, right? Dave Ramsey says all the time, the only people who get hurt on a roller coaster are those who jump off. And it's true, right? As long as that roller coaster is safe, and the stock market over a long period of time has been safe, the only people who are getting hurt are those who decided that they were going to bail, right? And the same goes for the S&P 500. So if you ever hear somebody go, I lost all my money in the stock market, first of all, it's not true, because the stock market's never lost all of its value, right? So if they did lose all their money, they did something exceedingly dumb, right? And then if they did lose a substantial amount of money, you should ask them, when did you sell, right? Because if you're holding on, then you've made a lot of money, right? Again, unless you've done something it's exceedingly dumb, okay? So I just don't want you guys to be worried. I don't want you guys to be just concerned about some of the headlines that are like, oh, the market's down again, the red on the screen on CNBC, or I don't want you to be concerned about the fact that, it's, the biggest drop that we've had in 227 days. I don't want you to be concerned about it being the worst September in months. Look, if the market goes down 30% in October, I'm going to be the first person in line to buy, right? I am not worried about the long-term value of the stock market. In the short term, may it be overvalued? Sure, right? May we need some substantial pullback? Sure. May there be catalysts in the world, in the economy, in politics and whatever, right, that are set to pull the market back? Sure, right? But that's not of my concern. What's of my concern is, can I buy at cheap prices, and can I hold for as long as possible, right? And if you do those things, then you're going to be successful, especially as an index investor. And again, I said this a little bit ago, but I want to double down on this. If you are a person who invests in individual stocks, now is your time, right? Now is your time to look around, because typically when the market's down 5%, there are probably some stocks that you own that are down 15, 20, 30, 40%, right? Now, that's not to say that you've held them through those drops, right? But from their highs. And if you have high conviction about those companies, you can absolutely make some great returns on the back end by doubling down and buying more of those shares. Now, obviously, there needs to be some fundamental basis for why you do so, but this is not a video on individual stock investing. I've done those before, right? But I'm just saying you could have some very, very great opportunities to maximize your money if you're buying things that are cheap, buying things that are on sale. Because ultimately, nobody wants to buy anything full price, right? If you looked around and you saw, that something was 20% off, and you had wanted it when it was full price, but you wouldn't pay full price, it's far more likely that you'll buy it at 20% off, right? Why is the stock market any different? Why is the stock market any different that when things are on sale, things are cheap, we want to avoid them, but when they're expensive or overpriced, we're like, oh yeah, that's what I want. I want to buy. It's irrational. Makes no sense. It's not logical. Okay, so ultimately, I just want you guys to be comfortable in the market. Know what you own, right? Especially right now. If the market's going to continue down, I cannot stress enough knowing what's in your portfolio. Because if you don't know what's in your portfolio and the market continues to go down, right, then the likelihood of you selling for a loss is way higher. Way, way higher. But if you know what you own, you know why you own it, you can write a short paragraph as to why you own it, right? And you know why you bought it, and the reason that you bought it still holds, then what's the problem? You should have no problem keeping that thing, right? This all goes back to what Warren Buffett says. If you buy an apartment house, or if you buy a farm, right? You're not going to that farm every day and looking for what the price is, right? You bought it at a cheap enough price, right, relative to its actual value, or you bought the apartment cheap enough to its value, and now all you're looking for is what it produces, right? Now it has to produce things for you. Okay, you're not asking for a price every day, and nobody's going to tell you a price every day, right? So why would we worry about it? We need to invest in a way that if the stock market shut down for 5 years or 10 years, Buffett said this before, right? Stock market shuts down for 5, 10 years, right? And didn't open, you couldn't trade, that you would be okay. That you would be invested in a way that, hey, your money's going to grow and you don't have to worry about, making trades in the short term and all these types of things, right? Now, is that going to happen? No, unless something catastrophic occurs, right? But I want you to invest in a way that you can be assured that your money is where it's supposed to be, right? You know what you own. You have some sense of security when it comes to your investment choices. Because again, investment operations, right? Ones that offer safety, right? Safety of principal, and offer an adequate return upon thorough analysis, right? So we need to make sure that both of those things are the case, and never forget that safety of principal part is actually there. That doesn't mean that we don't take risks. That just means that our risks are calculated. And that means when the market drops, jump in. That means when the market's down, by all means, right? But again, I'm not saying to put your emergency fund to work. I'm not saying to put to work, money that's just, saved up for different things that you need it for in the short term. I'm not saying to do that. I'm just saying if you have extra money, you might be a decent time to buy. If you have systematic investments that happen at the beginning of the month, fantastic. Let it happen and you're going to buy at a low, right? But just don't let down months sink you. Don't let down months take you into this spiral of thinking that the world's going to end, because the news will make you think that the world's going to end, okay? But it's not, right? Last year when the market was going down day by day and we ended up down 34%, every single day, I'll just never forget this because it was the first big crash that I've invested through, right? And every single day on CNBC, it was red at the bottom of the screen, really all around the screen, and it would say markets in turmoil. Markets in turmoil, right? Because it sells. Fear sells, right? And so that markets in turmoil would make everybody just get tense and worried and scared. But I kept reminding myself that this is the time. This is the time to be greedy when others are fearful. And then later there will be times to be fearful when others are greedy, right? And so anyway, I hope this helps you guys. I hope this helps you to have some decent outlook on what to think of the markets moving forward. Who knows where they go from here? They could go up. They could go down. Guess what? I don't care. But if they go down, I'm going to buy. They go up, I'm going to buy. But if they go down enough, I may buy a little more there. So hopefully this helps you and you can be a better investor by seeing down months like this, especially if you're a young investor. Hopefully this exposes you to some negativity that you can work your way through and be a stronger investor on the other side. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual watching or listening to the show on a day-to-day basis. So tune in Monday as I continue talking about personal finance topics that I think can be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.